Let's talk some stock news with Renita Young, our senior markets correspondent, joining us from the newsroom. We got FedEx last night on earnings. First move, the market was not a big fan. Renita, tell us about it.
Well, it's because revenue fell, Oliver, and it came in lower than expectations. Earnings, however, they were higher than expectations, but that was not enough to offset the lower revenue as well as the weak guidance, and also more proof that the company is experiencing some margin pressure. So here's a brief recap of the numbers. Adjusted earnings came in at $4.94 a share. That was above estimates, but revenue fell 10.1% to $21.9 billion. Below expectations. The fuel expenses, however, were down a little bit. They came in at $1.14 billion, and then operating margin was at almost 7%. Now, the company did issue relatively flat guidance for the next quarter, seeing low single-digit revenue growth, and this is all based on the economy. The company said during the earnings call that this ongoing demand challenge that prompted the company to ground 29 more aircraft in the fiscal year that started on June 1st. And it's because it's seen this global shipping downturn happen, and it's been causing FedEx to cut its costs. Now, the EVP and CFO, Mike Lenz, is retiring on July 31st. That's another piece of news that may be impacting markets today. Now, analysts, of course, they have mixed reactions today. JP Morgan actually raised the price target on the stock to $251 from $228, keeping a neutral rating on the shares, still really holding out hope. He said that he believes that the fiscal year 2024 guidance is a reasonable starting point given all the cross currents that have been happening, but also argues that FedEx does have a long road ahead to build up credibility with those who remain on the sidelines, and maybe, for instance, choosing UPS as a better stock in the industrial sector and in that subsector as well. Bernstein raised its price target on FedEx to $284, keeping an outperform rating on the shares. Now, this analyst said that while the company technically guided down, Bernstein thinks that the underlying earnings are still growing faster than the headline number suggests. And they believe that FedEx is doing enough on the cost side to be able to keep the stock moving, Oliver.
All right. Is a report that seems like it could have gone either way, but market here kind of choosing the side of disappointment. And it's been no shortage of volatility in the stock the last year and a half. Had that big COVID boom, everybody was ordering stuff online, then it came off, and then it came back with the market. It's actually been kind of connected to some of the NASDAQ style trades, and so we see it come off this morning. But there is some other trouble in paradise too, Renita. If we shift gears over to Tesla, actually a downgrade from an analyst, and stock has been carrying this market lately, so I feel like that's important too before we get to the opening bell.
Right, and so this stock, interestingly enough, it is slightly higher right now, even though it got a downgrade at Barclays, and this Barclays analyst actually feels like it may be, or analysts may be digesting this news today and what this stock actually looks like. So the analyst downgraded it to equal weight from overweight and raised the price target to $260 from $220, but that's still lower than the close from yesterday. This analyst said that the stock's performance has really been too sharp relative to the challenging near-term fundamentals that it's been seeing. Now, here's the caveat, Oliver. This analyst says that the analyst is still bullish on the long-term opportunity for Tesla, but it thinks that the long-term initiatives are going to take time to show through. And those long-term initiatives, we can guess, are cost cutting. They're also the tax rebates that customers are able to receive with several of the models now. But Barclays is forecasting for the second quarter deliveries to be at $455,000. That's above the consensus estimates, and that's also with a further inventory build possibility that this analyst expects. And that further inventory build, the analyst said, could add more questions to how the company decides to discount and the margin floor for both, the discounting and margin floor, Oliver.
Interesting. Okay. Well, cutting it, from a favorable rating, not exactly the most negative thing, but still one of these signs maybe of some of the exhaustion perhaps setting in, and some of the commentary kind of wanting to take effective profits, if you will. Having to bring up the price target as we've already surpassed it, but still below where we're trading right now, 275. Thanks, Renita. We'll see how Tesla shares handle the note this morning when we open up in about 12 minutes.